Looks like we are live. I was having some issues with my system here, and apparently I'm live. So hey guys, welcome. It's Chris Kirkpatrick. I decided to go live here today because of the fact that I've been having a lot of conversations with people today, and some of you guys know that I've taken on a new role as a Chief Marketing Officer for Everyday Wealth, and in that role, I've been doing a lot of coaching. I've been talking to life insurance agents and trying to help them through a lot of different stuff. And one of those conversations today led me to pull this book off my shelf, and I haven't looked at it in a long time. And it got me thinking about answering some questions for him. And it really got me just kind of fired up about ultimately some of the elements, some of the facts that I see and I speak to a lot. But as I rip through these pages and I start thinking about like the real power, it's crazy. It reinvigorates me to like really get into this stuff and understand what's going on. So what I want to do is just take maybe a half hour, maybe less. I don't know how long this will take. Go through this book and touch on a couple points that I think are really key to understand for people. Now, I think one of the biggest things to understand, people that hear me talk about whole life insurance being better than Index Universal Life, it's not that it's better or worse, it's just better for the intended purpose of using it as a savings vehicle. I think the conversation around utilizing Index Universal Life as an investment vehicle, as an alternative strategy for retirement planning, which is how most people use it, I think, you could have that, we could have that argument another day as to whether or not that's a good way to go or not. But for the purpose of this, I want to talk about life insurance as a savings vehicle. And ultimately, when I talk about how, if you look at the thumbnail in this video, it's why banks use whole life and not Index Universal Life. And so it's all about the fact that if you look at, if you've ever seen the Life 180 pyramid talk that I've done, I talk about the fact that you have to build the foundation first, right? The foundation of your financial pyramid. And when you do that, you have to have savings in there before you actually invest in midterm and then long-term type risk sorts of investments, right? And so the crazy part is when I was just going through this, it really made me think of some stuff, and it made me realize, like, so in here, if you haven't read this book, by the way, I will go get it. It's Pirates of Manhattan. If you question anything, if you sell Index Universal Life right now, you need to read this book, because I have a feeling it'll have you come around and start looking at whole life insurance a little bit differently, or at least open your eyes to some things. So here's the thing. Tier 1 capital is the core. I'm going to read some excerpts from this. So Tier 1 capital is the core capital of a bank. And so the purpose of Tier 1 capital is basically to cushion a bank in times of adversity and support other balance sheet assets. So i.e., the greater the Tier 1 capital a bank has, the more risk it can take on, right? Because it's got a great financial foundation. It's a financial fortress. It allows the foundation of the bank to be super strong. That way, if its other assets perform poorly, then it will perform, they'll be able to kind of weather the storm, so to speak. So at the end of the day, bank-owned life insurance. So banks take out life insurance. They could take it out as key man insurance. They put it on executives. They can take it out on clients that have large sums of loans with them, just to protect the balance sheets on the assets, just in case something bad happens to somebody that's borrowed a lot of money. But check this out. So this is an interesting, I'm going to see if I can show this to you. This right here is a crazy statistic. I know if I go, but I don't know if you could see that, but that is a list of banks and the amount of Tier 1 capital they have, and the amount of bank-owned life insurance that they have, all in whole life insurance, by the way, and what percentage of its Tier 1 capital it is. Like Wachovia Bank, 39% of the Tier 1 capital reserves that it has on hand, 39% of it is bank-owned life insurance, whole life insurance, right? Wells Fargo is 12%, Bank of America is 15%, JP Morgan's 10%, Washington Mutual 20%, Key Bank, big where I'm from back in Vermont, 38%, US Bank 26%, PNC Bank 26%. I'm trying to find banks. Bank of the West 23%, TD Bank North 32%. So you could see Compass Bank, 20%. New York Commerce Bank, 30%. So it's a huge amount of money that these banks have in Tier 1 capital. So in this book, Barry Dyke, he's the author, goes through, he says there's 8 reasons that they use life insurance as Tier 1 capital. And so I'm gonna try to go through this as succinctly as possible. This is a way different. I never like do this kind of video and read on my streams here, but let's give it a shot and see how it goes here. So at the end of the day, well, let me see here. I don't even know. Like I should have prepared for this a little better, I guess. I just got super excited. So the idea here is that the general account in a whole life insurance policy is managed extremely conservatively. So that's what he's saying here. Reason one that a whole life insurance policy can be used as Tier 1 capital by the bank is because the general account is managed very conservatively, and it's got the guarantees that go along with it, and it's highly liquid, right? So if they need it, the surrender value of the life insurance policy is available and accessible for the bank. So think about it this way, like, and I guess I'm jumping into 1 through 8 pretty fast, but think about it this way. If a bank is doing this, and if a bank is setting up their personal finances and investments and structure of their world, leveraging whole life insurance as a Tier 1 financial asset that they solidify and back everything up with, why in the world would we not want to do it as individuals, right? Corporate-owned life insurance, same concept. I'm focusing on the bank section in here, but there's a corporate-owned section as well, businesses that are doing this. And I actually, that'll be a different video because I don't want to get too down that rabbit hole. So reason number 2 that whole life is a great Tier 1 asset for a bank is there are tax benefits, and the tax benefits are crucial. Bankers are really smart people. There's no annual taxation of capital gains or cash value increases inside of whole life insurance. Whereas most company or bank-owned taxable investments are subject to interest, dividends, and capital gains tax, life insurance is not, right? So it's something to consider with the Internal Revenue Code. Pretty awesome. So reason number 3, life insurance provides a minimum guaranteed death benefit or to the bank or corporation, whereas taxable investments do not. So that's the way I would explain that is life insurance is a self-completing plan, right? Like if you're planning on saving money, right? We have multiple things that we need our money to do. A bank is no different. The bank has multiple things that it needs its money to do. A bank think about how a bank makes money. It pulls money in on deposits. You deposit your money in a bank. That increases its Tier 1 capacity, so to speak. It's Tier 1 capital. And then what it does is based on its Tier 1 capital, it can then loan money out, it can leverage money out, and they can earn money on lending, right? So when you put money into a bank, you earn 0.1% interest, and then they loan it out at 4%. They're basically making 40 times return on your deposit, right? So that's how they can make that work. And it's a little more complicated with fractional reserve banking and all that. But ultimately, that's the flow of it. Now, also, if a bank is doing that with whole life insurance, it's a self-completing capacity because like if you as a human being, we want to increase our Tier 1 capacity because when we do, we can then do the same thing. We can leverage it. The reason I love whole life insurance is because you can borrow against it and you can leverage it the same way a bank would do to get a bigger return on their Tier 1 capital, so to speak, right? And then the crazy part is it's self-completing, guys. Think about it this way. If you're saving money for the future and you're putting money in a savings account or you're putting money in an investment account and whatever, let's say you have kids, let's say you have any future things you need to pay for, weddings, college, maybe you're married and your husband or wife, they're stay at home and you want to make sure that they're able to keep the same standard of living and being able to show up in the lives of your children or that their college desires or future you want it to be taken care of on a guaranteed basis. By saving money in a savings account, you're only allowing your dollar to do one thing. By saving your money in an investment account, you're only allowing your dollar to do one thing. By putting your money in a whole life insurance account and you structure it properly, you keep liquidity, you get the return. Yes, it's a system that there's some expenses in on the front end, but at the same time, that dollar is doing multiple things for you. You're earning and having the liquidity of the money that's available. You're getting guarantees inside of that, so it's a financial fortress. It's that tier one asset that you're looking for. And when it does that, what's happening is if something bad happens to you, you have the life insurance behind it, right? Like you can actually take that life insurance, and if something happens to you, you basically can 10x or 20x or 30x your money in a lot of cases. And so by the time you have $100,000 in an account in a safe tier one asset, it probably comes along with $2 million of life insurance or $1.5 million of life insurance or something of that nature. And so that makes sure that, rather than just your family inheriting $100,000, which for most people I know, $100,000, if you got a couple kids and a stay-at-home spouse, it's not going to do enough to change their lives. Your stay-at-home spouse is going to have to go back to work. If something tragic happens to you, chances are your kids' college plans, the financial stress that's going to come along with it is going to be significant. And so if you think about that, it's just something that we want to make sure that we are getting our dollars to do more things for us. That's the concept of efficiency. That's leverage. And people, I think, miss the boat when they think about life insurance from that capacity. That's why when I talk about in my financial pyramid video, my Life 180 pyramid video, I talk about you want to have 2 years of safe income in an account, liquid and accessible. This is what I'm talking about. This is why you want to make sure that in case of opportunity, in case of emergency, you have this money and you have it earmarked for different things, but you need to have that tier one safe money saved before you go and start investing for other stuff. So that's reason number 3. Reason number 4, I'm just going to read this. Life insurance benefits come into the bank or corporation income tax free. Inevitably, there is a net gain to the bank at death on an insured employee or executive. Right? This is not subject to income taxes. In reviewing the financial statements of various banks, there were several documented instances whereby the bank reported significantly improved quarterly earnings when it received the proceeds of key persons' bank-owned life insurance. For example, in March 2004, Cornerstone Bank of Stamford, Connecticut reported non-taxable proceeds from a key man executive life insurance policy of $342,000, greatly improving its income for the first quarter that year. So it's the same. It's what I was just talking about, though. Ultimately, we're talking about the fact that it's self-completing, right? Like if something happens, you're going to have that influx of cash, and it's going to take care of your needs there, and it's going to be tax-free, right? Like if you're passing from generation to generation, there's going to be tax consequences if it's in qualified accounts, if it's in any kind of savings account or a capital gains account, and it passes forward, right? Like if it passes from generation to generation, from like a father to a son, there's going to be taxable consequences. However, if it goes to your spouse, right, then the tax ramifications are a little different. But regardless, having that benefit is huge, knowing that you're going to be protected from a tax perspective. All right, reason number 5. Unrealized gains or losses cannot be recorded on taxable investments, but banks can recognize the increase in cash surrender value as a credit to earnings. In this way, banks and other corporations improve their income statement between 1 to 2.5%. For instance, in 2002, the Bank of America reported $570 million in additional revenue and $170 million in net profits to the bank by using bank-owned life insurance. A 1 or 2% increase in earnings may not sound like much, but it is extremely significant in the eyes of Wall Street. Wachovia, for instance, says bank-owned life insurance contributes about 3% to earnings, whereas Branch Banking and Trust Company in Winston-Salem, North Carolina, says bank-owned life insurance contributes to 1% earnings, right? So the whole idea here is it's just efficiency. You'll hear me talk and beat on this. I'm also doing a review right now that I'm going to release on Caleb Williams' book, The And Asset, talking about financial efficiency. And it's impossible to be 100% financially efficient without enough tier one savings in your financial life. That's just a fact. So that's that. Reason number 6, here we go. In periods of low interest rates, banks have cheap access to money through their central bank, the Federal Reserve System, right? We all know the Fed. They can borrow at bargain basement rates with the Fed, invest in life insurance, and not only gain all of the above benefits, but also make money on the spread. So that they're talking about arbitrage, right? So this is the same reason when I say people shouldn't pay off their mortgage right now, right, in a house. It's just understanding the concept of arbitrage and why would you pay off low interest debt that has tax advantages, where you're tying all your net worth up in the value of your house when you pay it down faster. Why would you pay that off when you can have your money earning, growing on a guaranteed basis above and beyond that? Once again, the banks don't go out and use Index Universal Life for this. Why? Because the guarantees in Index Universal Life are not there. The guarantees in whole life are. Now, granted, that's kind of a tough story. I know I tout the benefits of the guarantees of whole life a lot, and it's kind of maybe overly touted because of the fact that none of the insurance companies I would ever suggest anybody to use have ever had to rely on the guarantees. They've always paid a dividend above and beyond the guarantee for 150, 160, 170 years, right? So like, to me, it's a little overplayed, but at the same time, having those guarantees is what allows you to implement a financial system that is beneficial, right? Like that, I think that's the key part is what's the financial system and process that you're implementing, and how does the financial product fit into that process, right? Once again, you think about Index Universal Life, not saying it's bad, but I'm saying you can't compare it to whole life insurance because it doesn't do the same things. It's not designed to be a banking alternative. It's not designed to be a tier one asset. It is more in alignment to like a Roth, anything you would compare as far as performance in a Roth. So comparing a IUL to a Roth, we can have that conversation, and I may get behind, doing that. However, I'm just not a big believer in investing in a Roth either way, putting my money in the market and having that zero-sum game mindset of accumulation, of having all these moving parts that I'm just not in control of. Maybe I'm a control freak, but I'm a big believer in creating a system and a process where I'm in control of the results of my life. And to do that, you need to have your money in a product that don't have the moving levers that can hurt you. So reason 7, investing in permanent life insurance, particularly when banks make mammoth purchases, offers banks professional money management options, right? So purchasing life insurance based on the investment return of a general account of a life insurance company is the safest and most prudent course of action for consumers. However, through their purchasing clout and financial sophistication, banks can negotiate more pass-through income to their bottom line. So even banks do this. They realize like they're in the banking game, they're not in the investment game. So what are they doing? They're giving their money to insurance companies because insurance companies, this is what they do. They've done it for over 150 years, right? They literally take money, they invest it safely, they understand all the moving parts of markets, they understand how to get good, consistent, safe returns. That's what they do. And even banks who understand that they're not going to be able to do what insurance companies do, so that's why they want to keep a high percentage of their tier one assets with insurance companies, because that'll get them the returns without losing liquidity, right? Like that's pretty amazing stuff. So reason 8, and the final reason, life insurance companies lend money out to third parties in a similar manner to banks. However, unlike banks that inflate their money supply to the public through fractional reserve banking, life insurance companies do not have this ability. This makes a life insurance company inherently stronger than a bank, as it has less exposure than an over-leveraged bank, right? So that on its own, guys, I'm telling you, is worth its weight in gold. Life insurance companies are financial fortresses. I use that phrase all the time. You can steal it from me, go nuts, because even banks, a lot of people, yes, they're FDIC insured, but there's a reason they have to have that insurance, because there's been so many banks that have failed. If you look at these mutually held life insurance companies that I'm talking about, that I would suggest anybody to use, they've never needed to be bailed out. They've never missed dividend payments. Even since the 1850s, they've never even had to rely on their guarantees. We're talking about, think about this. Go back to 1850. What's happened since 1850? The Civil War was in the early 1860s, right? So the Civil War, the banks didn't even miss dividend payments. You know, the Great Depression, the crash that happened, it was like 1907, then the Great Depression, then the World War I, World War II, Korean War, Vietnam, the dot-com bubble, 1980, the stagflation in the late 70s, the Black Friday, or was it Black Monday? Well, the 1987 dot-com bubble, 2008 Great Recession, and here we go. So check it. I mean, like, think about that. This is insane, right? Like, life insurance companies are the most stable companies in the world. But here's the deal: bank-owned life insurance. Okay, so I talked about bank-owned life insurance. We got there was a part in here on. Let me see if I can find it really quick. It was pretty awesome, actually. Let's see here. I don't know if I'll be able to find it on last second notice here. I'm not really prepared to look for it. But there's a part in here on corporate-owned life insurance. And it basically talks about all the executives, and this is why everybody should get this book, all the executives that leveraged their buyout plan, leveraged their pension to not get buyouts and stock in companies, but to make a bigger, well, not that they didn't get stock, because they did, but to make sure that they had a bigger portion of their pension with their company buying life insurance on them, and utilizing whole life, permanent whole life, properly structured life insurance on them, because there was going to be, it's all the reasons I just told you. It's the self-completing tool that is what it is. Let's see here. So anyway, I literally could do a review on this book, and it would be crazy. At the end of the day, there's so much going on here. I'll have to get back into this, but I wanted to hop on here and just kind of tell you guys about this one component of it all, right? Of the tier 1 capital, about how banks, the 8 reasons why banks use it. And the fact is, if you look at those 8 reasons, it has to be whole life insurance. It cannot be index universal life insurance, because there are too many moving parts to index universal life insurance. And believe me, if I know everybody sits here and they say, listen, index universal life has the upside opportunity, it's got the downside protection, and if it were as good as everybody said it was, right? Like, as all these agents out there are saying it was, guess what? Banks would be all over that stuff, right? Because insurance companies are great at investing, right? Their general funds are great. But guess what? I always say you can't separate performance for an IUL company compared to that IUL company's insurance company's general fund, right? If that general fund is earning 5% and you know, the IUL says long run, it's being illustrated at 6.4%, it's just not going to perform there long run. Unless the fixed economy goes up and improves, companies are going to drop cap rates on IULs. I know everybody out there is saying that they're not going to, but guess what? I had somebody send me an illustration the other day from Midland, and I'm looking over this illustration, and this thing was sold with a 12.5% cap rate like 5 years ago, and it's already down to 8.75%. Think about that. Like, that's insane. Like, on the in-force illustration, the policy review, that's what's happening. So, like, these are the things that are happening that to me, you know, people just don't realize. People are great at selling index universal life because of the fact that, like, it looks sexy on paper. It's pretty compelling, easy story to sell until you really get into the nitty-gritty details, surface level. Believe me, if it was that good, if it had all the upside and it had no downside, and you know, the variables in the product couldn't be moved, I'd be all over it. There'd be no better product on the face of the earth. But guess what? That's not how it works. So anyway, I don't know if that helps or hurts, but hopefully people found value in it. I didn't even plan on doing this video. I was just sitting here, I was reading this book, and I was thinking about it, and I'm like, heck with it. I'm just gonna go live and talk about it because it's fun. I enjoy this stuff. I'm just sitting in here working, answering calls, and dealing with all this stuff, and I just, you know, hopefully you guys found value in it, and you know, we'll go from there. So anyway, if you have any questions, go ahead and leave them in the comments below. I'm not seeing any comments right now. So I hope this helped. I hope it made sense. If not, leave a comment below. Happy to engage. And anyway, I hope you guys have an amazing weekend. I've got some great videos coming out this weekend. I actually have my And Asset book review. I'm going to be creating section by section, chapter by chapter, is going to start coming out tomorrow. So be on the lookout for that. Engage if you have any questions. We're also I'm going to have a link below in those videos. If you want to get your free copy of the And Asset book, you can click on the link and head on over. It's not in this video. It'll be there this weekend. So if you haven't already, make sure you hit that subscribe button. Click the bell, that way you get notified every time I launch a new video. If you're new here, welcome. Thank you for being here. Honored to be able to talk with you. And that's it, guys. I hope you have a blessed, inspirational weekend, and we'll talk to you. I guess you'll see me tomorrow, but I'll be back to work next week. So, all right, later, guys.